This will shock you. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, this is my most important video of the year because as you're about to see over the weekend, the media buried an article with government data in it that indicates that the U.S. economy is in far worse shape than the political elites in Wall Street want you to believe. And once you see the data, it's going to change everything you know about what's going on and why it indicates we're a matter of months or maybe even less to an all-out recession. And we also have some new information on China that indicates their entire monetary system is on the brink of total collapse. I'll show you the shocking data. Plus, we have a sponsor of today's show. We'd like to welcome Resolve AI. You can find them on the NASDAQ under symbol RZLV. And if you're a swing trader, you're going to love this setup. Resolve AI is an AI-powered platform for e-commerce businesses to optimize online stores. And they've recently partnered with Microsoft. And again, once you see this setup as a swing trade, you're going to see a potential 30% return. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, let's over to Bloomberg where we picked today's story up. And I want you to see the headline. This was the article that was buried. It says, record seasonal adjustment tones down the blowout U.S. jobs report. And what have we been hearing ever since Friday is how the U.S. economy is in fantastic shape, that we're going to achieve the goals set forth by the Federal Reserve to hit this no landing or soft landing scenario, and that all indications of doom and gloom that the U.S. economy is headed into recession, well, those are off the table now. We're looking for a massive boom, a return to inflation. And that's exactly what we've seen in some of these articles. I want to look at some headlines, and then we're going to dig into what's really going on with the payroll report. Let's see this today. Bond traders buckle up for a no landing after a job surprise. And this is exactly what I said was going to happen following the non-farm payroll report, is you're going to see all the news and media jump behind this one-off report that we talked about is actually a potential leading indicator of a recession. Now, if you're wondering what a no landing scenario is, it's a situation where the U.S. economy keeps growing, inflation reignites, and the Federal Reserve has little room to cut interest rates, had largely disappeared as a bond market talking point in recent months. And what did it take? A blowout payrolls report to revive it. But what if that report wasn't what we think it is? What if it wasn't what the headline number suggests? And that's what changes everything. But again, let's take a look at a couple more headlines that's dominating the news today as U.S. yields back at 4% for the first time since August on Fed rethink, as now everyone believes that the Federal Reserve, who is going to make several more cuts this year, may not make any, or may only make one, possibly even two. And this is caused people who are long the bond market to start dumping those positions and get prepared for a rebound in inflation and yields. But it's not just the bond market. Even the banks are behind this move. As we see, Goldman now cuts the probability of U.S. recession in the next year to a mere 15%. So everybody's on the bandwagon now saying that the Fed may only cut 25 basis points. And in my show the other day, this is exactly what I said would happen. The news of the payroll report would drive all this euphoria about the U.S. economy. It would get people to want to buy into stocks, get out of bonds, and it changes the game here. But once you see the truth, it's very eye-opening. But something that is increasing your probability of success, well, that is the stock for our sponsor for today's show, Resolve AI. You can find them on the NASDAQ under the symbol RZLV. I want to take a quick look at this chart. We're going to look at it here again later in the show. But this tan line right here is the 9-day moving average. And if you're a swing trader, you want to see a full close above this. So we're a matter of perhaps a day or two away from seeing this, and I'm going to show you how this can take off to a potential 30% return. Again, stay tuned to the end of the show or check out the pinned comment or description for more information, because even Powell's outsized influence signals smaller Fed cut. This according to another investment bank, Nomura. So everybody again saying, wait a minute, Powell, you made a mistake. You didn't see this big payroll report was coming. And what it indicates is a soft landing narrative has been achieved, and that we're about to see a surge in demand for U.S. consumers that's going to drive hiring. And all it took was a 50 basis point cut to reignite inflation and change everything. And that is until you get to the details of this report. Check this out, because the Bureau of Labor Statistics, which compiles the employment report, uses a model to fine-tune the raw change in payrolls to better account for seasonal factors like summertime fluctuations when teachers are off, construction jobs are booming, and restaurants hire additional staff. That way, the numbers are more easily comparable month to month. And that's true. What we see is these things called a seasonal adjustment. And all it's designed to do is smooth out the data. So when you look at it on a chart, it looks something like this. And instead of seeing these wild month-to-month gyrations, what you see is a rather smooth line that we can see the direction of the economy. But what if the seasonal adjustment caused the number that we saw on Friday to be abnormally too high? Well, that's a factor here because it could suggest that the U.S. economy didn't generate all those jobs. In fact, it may have actually only generated a fraction of those, pointing us down to a recession. And again, we talked about this in the show the other day, that we saw the same effects going into the dot-com bubble, and we really saw nearly a mirror of this setup going into the financial crisis, where the Fed cut 50 basis points, and then everybody jumped on the bandwagon after a hot non-farm payroll report and told the Fed, you only need to do 25 and maybe another 25 just to juice the economy. We're seeing that same setup now. And last month's so-called seasonal factor, which is calculated by dividing the total seasonally adjusted payrolls count by the unadjusted figures, get this, was the largest for any September in records back to 2002. So we have this massive seasonal adjustment. And again, you didn't hear any of the news come out on Friday when the report was released saying, hey, wait a minute, this is a big number, but by the way, there was a big seasonal adjustment to this. We'll only find this out later, and then it gets buried by the news because they want people to believe that the economy is booming, because this will get people who are on unemployment to go out and look for a job, believing that there are employers hiring. And yet, what do we see in, of course, the survey data? We hear employers saying, hey, you know what? We're cutting hours here. We don't have a lot of demand, so we're also cutting jobs. And yet, we get this government data that says, boom, look at the economy. Inflation's back, the economy's back, the stock market's going to boom, but maybe the opposite is actually going to happen. We're in a different era for how the BLS seasonally adjusts jobs data, as evidenced by the fact that the biggest September seasonally adjusted factors in history have all been in recent years. And this is one of the issues we've been facing, is bad data leads to bad policy and bad decisions by investors. And what we're setting up here is for the potential for the Fed to be behind the curve by a massive amount of 6 months. If you could imagine that, the Fed being so behind here suggests that even if you do believe in the magic of Fed rate cuts and their effect on the economy, what this suggests is by being so far behind the curve, the Fed's not going to be able to stop any downturn. And I'm not entirely sure why this, according to a Scotiabank economist. What this means is that we should be looking at reported job growth and smoothing the figures over time. What it means is we can't take the non-farm payroll report at face value, and we need to look at other data points, such as the unemployment rate, as you see here in blue, or continued unemployment claims shown in red, which are not indicating a booming economy. If indeed we saw 245,000 jobs created, why didn't the unemployment rate come down more? Or why didn't we see a bigger shift of people come off continued claims? Or was this just the fact that someone lost their job and was so in demand that they immediately got another job? That could be the case, but I don't buy it, and neither do some of the experts. As payrolls rose by 254,000 last month, above all estimates and the most since March. The gain was driven by restaurants and bars industry, construction and retail, and strength in those industries points to a tailwind from some combination of favorable weather and or seasonality that's unlikely to persist. And this doesn't make any sense because I live in the vacation capital of the world. This is where more people come to vacation than anywhere else. And I know a ton of people in the service staff area, and what they're telling me, the bars, the restaurants, their capacity is down. People are coming in, spending less time there. There's open tables, open seats. You can get in. In fact, many of them are complaining that their employers are cutting hours and cutting jobs, forcing many of them not to just have 2 jobs, which is quite common in the industry, but to go look for a 3rd job. So what we're seeing in the news, of course, by the government telling us what's happening and what's actually happening are very, very different here. Since any seasonal distortion in this release represents overcompensation for seasonal distortion in the other direction in earlier months, one can conclude that this report is either strong or the prior reports were not as weak as previously thought. Now, that would actually make sense if the government went back and the BLS said, hey, you know what, there's a seasonal adjustment here, but we're going to go back and correct that into prior reports so we can see the smoothing effect of the economy slowing down. But instead, they decided to lump it into one report, and you could see the change by the headlines. All of a sudden, it reacts to the bond market and what the Wall Street is telling the Fed they need to do. And if you don't think the Fed listens to what these major banks are saying, of course they do, because the Fed is a banking regulator. That's what their job is. So if the banks tell the Fed, hey, you only need to do a quarter basis point going forward, that means the likelihood of the Fed doing that goes up. And then we go back to the 2007 data. What did we see? A slowdown in payrolls, a big jump one-off month. The Fed cuts 50 basis points and then goes to a 25. And then what happens? The whole economy falls apart. Job losses become rampant, and it's game over for the Fed. Another complicating factor could be the establishment survey's response rate. Check this out. Just 62.2% of businesses in the sample filed responses on time for the first estimate, the lowest for any September since 2002. So how do we even believe the accuracy of this report? So you start to see there's multiple issues here going on. One of them being the fact that we had this large seasonal adjustment drove the number up. And the fact is, how did the BLS even know the number that they published was real? Well, they don't, because only 62.2% of businesses responded. And looking at the two subsequent collections over time, the response rate usually ends up toward the mid-90%, and that revised data can swing largely as a result, indicating that we could see this 254,000 number downwardly revised in a big way in the coming months as responses eventually make their way to the government desks of those who actually handle the surveys. And this is dangerous because you see the reaction in it right now. And we're coming up, of course, to the next Fed meeting early in November, so that's about a month away, suggesting that another policy mistake is about to be made. The extremely low response rate to the payroll survey waves a red flag. We think that small businesses are disappropriately late responders and are cutting back on hiring more than large businesses. Now we know that. And how do we already know that? Because we looked at the Conference Board data, and what did they say? Small businesses are laying off. What did ADP say? Small businesses are laying off. They're worried about demand. They're cutting hours. We know this is happening today, but it's not showing up in the headline non-farm payroll report. We are convinced, therefore, that September's print will be revised much lower over the coming months. But again, it's too little too late, because you're seeing people make investment decisions based on this. They're seeing the headline data and they're saying, wait a minute, maybe I should go and buy stocks because the economy's booming. And the Fed's going to make policy decisions based on this data, only perhaps for us to find out in the months to come that the 254,000 number was completely wrong. But one thing that is right is what the bond market continues to tell us about the labor market. As we look at the yield curve here shown in blue, and it's inverted when you see it, the blue line below that horizontal black line, which is indicating that 2-year yields are higher than 10-year yields, and that's abnormal. But as, of course, you see the line steepen here, what that means is interest rates are falling and financial conditions are tightening. And we've overlaid the unemployment rate against that shown in red, and what you can see is as yields fall, financial conditions don't ease as everyone believes. You don't see a lot of new lending and spending activity. What you see is financial conditions tighten, and next thing you know, more and more Americans lose their job, get on the unemployment line, and get stuck there. This time, due to one payroll report, everybody says it's changed, and yet now we know the truth, that the response rate was extremely low and the seasonal adjustment was extremely high. But it's not the only U.S. economy that's facing danger. We turn to China, who's about to see their entire monetary system outright collapse. And this was reported by Goldman Sachs. China must do QE now, or it will end up in a bigger hole in 12 months. And what is quantitative easing? Well, it's the creation of bank reserves. And why does this matter? Well, China's been seeing money leave their financial system, come overseas. And this is not much different than what we saw during the gold standard in many years past, where the United States accumulated massive amounts of gold and money kept flowing into the United States out of other countries and triggered a global recession. What happened is the Fed ended up cutting rates into a hot economy. Sounds very similar to what we're seeing today. Why create bank reserves? Well, because money again is drying up there, and that's a problem. In a debt-based economy, you need to see the constant expansion of the money supply and money. Of course, we know banks are the only institutions that create money. And so what do you do when things go wrong? Well, you go to the banks, you lower interest rates, you force them to change their policy, you extend and pretend their loans. This is all what's happening in China right now. And then eventually you turn to QE, where you drop interest rates back down to zero, start buying up bonds, and force money into the banking system to keep it solvent. And this is a case that Goldman's making. China has no choice but to activate QE, as we're going to see that everyone else is going to do as well. There's two things to watch according to Goldman's: the M1 and M2 dynamics. These are the money supply and curve steepness. If the rally has legs, you need to see M1 growing faster than M2 as demand for settlement balances above demand for savings and balances, and you need to see a much steeper curve. And then you see this. Well, I want you to note the M1 shown in blue is outright collapsing as the supply of money in China is dropping. That's suggesting that the M2 is going to follow. Now, looking back in 2015, 2016, what happened? We saw perhaps a global recession starting to form. China eventually turns this around, and the U.S. consumer helped as well. But how about the financial crisis? You see a big surge in M1 and M2, collapse leading to a financial crisis, collapse going into the dot-com bubble. And what this indicates is not only is the U.S. economy in danger due to the false reports on the payroll numbers that we're going to get caught up here in a matter of months. We'll find out that the U.S. economy is actually closer to recession than not, as we see a repeat of 2007. But now we find out that China's entire monetary system is on the brink of outright collapse. But one thing we're bullish on is that is the stock for our sponsor for today's show, Resolve AI. You can find them on the NASDAQ under symbol RZLV. And again, if you're a swing trader, this is a potential 30% move. You got to look for that candlestick close above the 9-day moving average. But let's talk about what Resolve is, as they design and build AI for commerce, providing innovative new sales channels that help your customers save time and money. And Resolve Brain is an AI-powered platform for e-commerce businesses to optimize their online stores with enriched taxonomies, personalized recommendations, and conversational AI-powered shopping interface. Resolve's Brain technology delivers personalized product recommendations for each visit based on what it learns about products and customers. Customers can ask questions about products without having to pick up a phone, while ordering is quick and simple through Resolve's trademark instant checkout experience. Our solutions enable retailers, brands, and manufacturers to create robust connections with their consumers. With advanced analytics, personalization, and cross-channel engagement features, Resolve helps businesses drive commerce and engagement like never before. And with a recent partnership with Microsoft, is setting up some big moves in their stock. Again, this is a swing trade. Look for that close above the 9-day moving average. We'll talk about that more in a moment. But let's talk about the partnership, as Microsoft and Resolve AI partner to drive global retail innovation with AI-powered commerce solutions. Through this collaboration, Resolve AI's Brain Suite, including Brain Commerce, Brain Checkout, and Brain Assistant, will be powered by Microsoft Azure and available globally via Microsoft Azure Marketplace and co-sell channels. The partnership aims to empower retailers to transform their customer engagement operations with advanced AI solutions powered by the Microsoft Cloud. In addition, Microsoft will extend extensive go-to-market and co-sell support, provide marketing, sales, and technical support to accelerate Resolve AI's market penetration over the next 5 years. The potential for generative AI to transform retailers' business is immense. Through this partnership, we will combine the power of Microsoft Cloud with Resolve's purpose-built solutions built on their unique Gen AI models to bring a differentiated conversational AI experience to our mutual customers. Together, we can provide retailers with the tools they need to personalize shopping experiences and streamline operations at scale. And there's many aspects of this partnership, such as leveling up digital and commerce engagement, global distribution via Azure's Marketplace, extensive go-to-market and co-sell support, and that means there's a big opportunity in their stock. Again, check them out on the NASDAQ under the symbol RZLV. And here again, we're looking back at the 9-day moving average shown in gold here, and what we're looking for is a close. The candlestick opens and closes above the 9-day moving average, and that signals the beginning of a swing trade. Now, you see in green, this is a 21-day exponential moving average. This is where you later look for a sell signal signal. But right now we're focused on this rising 9-day moving average and the stock rising here. Look to take advantage of this as a swing, because what you see on this next slide here is the RSI and MACD are rising. So you see momentum building behind Resolve AI stock. And where is it trading right now? Right at its major volume profile line. And so when you see it break and close above this, along with that close above the 9-day moving average, well, it sets off a huge move. One we think up to is $9.38 level. You can see where that stock has shot up 3 previous times, setting up a potential 30% move. And as we zoom into the 10-day chart, you can see all it needs to do is close above that 10-day volume profile. Then it sets up a massive move higher. Again, we see momentum building in the short and the long term, setting up again what we see as a potential 30% remove in Resolve AI stock. Again, you can find them on the NASDAQ under symbol RZLV. But as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.